Welcome to the Money Context, where we explain how money systems work. If you find this kind of explanation helpful, consider subscribing. This channel is about clarity, context, and understanding how economic systems actually affect everyday life in the United States. Most people use money every single day, but very few people ever stop to ask a simple question. Where does money actually come from? We work for it. We save it. We borrow it. We worry about it. But the system behind it feels distant and complicated, like something handled somewhere far away by experts in suits inside buildings we never enter. So today, let's slow everything down and walk through how the U.S. money system actually works. Calmly, simply, step by step. First, it helps to understand that money is not just paper bills or numbers in a bank account. Money is a system of agreements. It is a shared understanding that something has value because everyone agrees it does. In the United States, the official currency is the U.S. dollar. Those physical dollars are issued by the U.S. Treasury, but most of the money in circulation today isn't physical at all. It's digital. It exists as numbers inside bank accounts. That's where things start to get interesting. When people imagine money being created, they often picture printing presses running nonstop. But in reality, most money in the United States is created through lending. Yes, lending. Here's how it works in simple terms. When you deposit money into a bank, the bank does not just let it sit there. Banks are businesses. They lend out a portion of the money deposited with them to other people for mortgages, car loans, business loans, credit cards, and more. When a bank approves a loan, it doesn't physically hand over stacks of existing cash. Instead, it creates new digital money in the borrower's account. That money did not exist before the loan was issued. In other words, when banks lend, they create money. That newly created money enters the economy when the borrower spends it, buying a house, paying tuition, purchasing equipment, or covering expenses. This means a large portion of the money supply grows when debt grows. Now let's zoom out to the bigger level. Overseeing the broader financial system is the Federal Reserve, often called the Federal. The Federal Reserve is the central bank of the United States. Its role is not to control your personal finances, but to help manage the overall stability of the financial system. The Fed has several key tools. One of the most important is setting interest rates. When the Fed lowers interest rates, borrowing becomes cheaper. Loans cost less. Businesses expand more easily. Consumers are more likely to finance homes and cars. Money moves faster through the economy. When the Fed raises interest rates, borrowing becomes more expensive. Loans slow down. Spending can decrease. This is often done to slow inflation. Inflation, simply put, is when prices rise over time. Some inflation is normal in a growing economy. But when inflation rises too quickly, it can reduce purchasing power, meaning your dollar buys less than it used to. So the Federal Reserve adjusts interest rates to try to keep inflation stable while also supporting employment and economic growth. It's a balancing act. Now here's something many people don't realize. The government also influences the money system through spending. When the U.S. government spends more than it collects in taxes, it runs a deficit. To cover that gap, it issues treasury bonds, essentially borrowing money from investors. Those bonds are purchased by individuals, institutions, and sometimes even the Federal Reserve itself. When the Fed buys government bonds, it increases the money supply by adding liquidity to the banking system. This can sound complicated, but the core idea is simple. Money flows through a combination of bank lending, central bank policy, and government spending. It is not a single faucet that gets turned on or off. It's a network. Now let's connect this to everyday life. When banks are lending easily and interest rates are low, money tends to circulate more freely. Asset prices, like homes and stocks, often rise during these periods because borrowing fuels demand. When interest rates rise, borrowing slows down. This can cool off housing markets, slow business expansion, and reduce spending. If you've ever wondered why mortgage rates suddenly change or why credit card interest feels higher, it often connects back to these larger policy decisions. But there's another layer to understand. Because much of the money supply is created through debt, economic growth is closely tied to borrowing. When borrowing expands, the money supply expands. When borrowing contracts, the system can tighten. This doesn't mean debt is automatically bad. Loans allow businesses to grow and families to purchase homes. But it does mean the system relies heavily on continued credit activity. Now consider how this affects financial stability. If wages grow slowly while the cost of living rises, people may rely more on borrowing to maintain their standard of living. That increases debt levels. And because debt creates money in the system, the expansion of credit becomes part of how the economy continues operating. You can begin to see how interconnected everything is. Work, wages, loans, housing prices, interest rates, inflation, they are not isolated problems. They are pieces of one large financial structure. Another important piece of the system is confidence. Money works because people trust it. They trust that dollars will hold value tomorrow. They trust that banks will honor withdrawals. They trust that employers will pay wages. If confidence weakens, people pull back. Spending slows. Investment declines. That's why financial stability is as much psychological as it is mathematical. During economic downturns, you may hear about the Federal Reserve injecting liquidity or lowering rates. That's not just about numbers. It's about stabilizing confidence in the system. So where does this leave the average person? It means your financial life is connected to forces larger than your individual choices. That does not remove personal responsibility, but it adds context. When housing prices rise rapidly, it often connects to low interest rates and high liquidity. When inflation increases, it may reflect supply issues, strong demand, or monetary expansion. When credit becomes expensive, it may reflect efforts to control inflation. Understanding the system doesn't solve everything overnight, but it changes how you interpret financial news and personal pressure. Instead of asking, "Why am I struggling alone?" you may start asking, "What broader forces are shaping this moment?" The U.S. money system is not mysterious magic. It is a framework built over time, involving banks, a central bank, government spending, markets, and public confidence. It evolves. It adjusts. And sometimes it creates unintended side effects. Rapid money expansion can support growth but also fuel asset bubbles. Tightening policy can control inflation but slow employment. Government spending can stimulate demand but increase debt levels. Every tool has trade-offs. That's important to remember. Economic systems are not designed to produce perfect outcomes for every individual at all times. They are designed to maintain overall stability across a large and complex country. When you hear phrases like, "the economy is strong," that often refers to metrics like GDP growth, employment rates, and inflation levels. But those metrics don't always capture personal financial strain, because the money system operates at scale. It manages flows, not feelings. And that distinction matters. The more you understand about how money is created, circulated, and influenced, the less confusing financial headlines become. You start seeing patterns instead of randomness. You begin recognizing that interest rate changes ripple into mortgages, auto loans, and business expansion. That government deficits influence bond markets. That lending behavior affects money supply. And slowly, the system becomes clearer. Money is not just income. It is policy, credit, confidence, and circulation. It is structured. And when you understand the structure, you gain perspective. Not control over everything, but clarity. And clarity changes how you interpret financial stress, economic news, and your place inside the system. Understanding the U.S. money system doesn't require advanced degrees or insider access. It requires stepping back and seeing how the pieces connect. Banks create money through lending. The Federal Reserve manages liquidity and interest rates. The government influences the system through spending and borrowing. Confidence keeps it functioning. That's the foundation. And once you understand that foundation, the rest of the conversation, inflation, housing, debt, inequality, asset prices, begins to make more sense. This is not about fear. It's not about blame. It's not about politics. It's about context. Because when you understand the system, you stop seeing money as a mystery and start seeing it as a structure you live within. And that shift matters. For more calm, clear explanations about how economic systems shape everyday financial life in the United States, consider subscribing to The Money Context. Understanding the system changes how you see money. Thank you for watching.